Jerry Romine here, and today we're demystifying the world of options like you've never seen before. Think of it as your favorite movie trailer, but instead of the next blockbuster hit, you're unlocking the secrets to financial empowerment. Let's dive into the realm of options without losing your wits, shall we? Picture this, you've got a golden ticket, but it's not for Willy Wonka's chocolate factory. It's for something even sweeter, the chance to make or break in the stock market with options. But here's the catch, that ticket has an expiration date. Just like milk past its prime, an expired option won't do you any good. So what's the big deal about these dates? Stick around and I'll tell you why timing in options trading is everything. Now imagine walking into the grandest buffet you've ever seen, but instead of dishes, you've got expiration dates on those options. Monthly options, that's your hearty main course. Weeklies, the spicy appetizer you can't get enough of. Dailies, the shot of espresso to kickstart your trading day. And leaps, the fine wine you savor for years. Each has its place at the table depending on your appetite for risk and reward. Diving into the strategy of selecting expiration dates is akin to mastering the art of timing in comedy. It's everything. When you're strategizing about options, you're not just picking dates out of a hat. You're aligning your financial goals with market rhythms. Think of each option like a ticking timepiece, each tick moving you closer to your moment of truth. If your strategy is short-term, akin to sprinting through a thrilling 100-meter dash, then weekly or even daily expirations might be your best bet, allowing you to capitalize on quick market moves. However, for those with a marathoner's endurance, aiming for long-term growth or hedging positions, leaning towards monthly or leaps provides the breathing room needed for your assets to mature like a fine bourbon, revealing their true value over time. Yet, the strategic depth doesn't end at mere time frames. It intertwines with understanding market volatility, event-driven strategies, and your personal risk tolerance. It's about reading the market's ebb and flow, much like a seasoned captain navigates the open seas, using the stars of economic indicators and corporate earnings reports to steer clear of storms. Picking the right expiration date involves peering through your financial telescope, predicting how events like product launches or policy changes might sway stock. This anticipation, combined with a keen awareness of one's financial horizon and stomach for risks, crafts a strategy that's not just smart, but personalized. Like tailoring a suit, it's about custom fitting your options portfolio to your life, not the other way around. The tale of expiration dates and option pricing is one for the ages, a nuanced romance that unfolds over the life cycle of an option. At the heart of this story is time value, the premium you pay for what could happen before the option expires. In the bloom of youth, when the option is far from its expiration, this time value is plump and juicy, brimming with potential. It's the hope that the stock will soar or plummet depending on whether you're holding calls or puts, and the longer the time frame, the more you pay for this hope. But as the stock clock ticks down, this time value begins to wither, dwindling to a whisper as expiration looms. This inevitable decay, known as theta, is a reminder that in options trading, time as a commodity is valuable as the stocks themselves. However, there's beauty in this decay, a strategy to be leveraged. For sellers of options, this time decay is the slow-burning candle that lights the path to profit, as the options they sell shrink in extrinsic value with each passing day. For buyers, the challenge is to find the moment when the potential for an option's increase in intrinsic value, that's the real movement in the stock price relative to the strike price, outpaces the loss of time value. This delicate balance between timing, market movement, and decay is the essence of the options dance. Mastering it requires not just an understanding of the mechanics of options, but a feel for the market's rhythm, the ability to anticipate the beat before it happens, and the wisdom to act before the final note is played. I personally sell a lot of cash-secured puts and covered calls for weekly income, which takes advantage of the time decay. And for those diving deeper into investing, I give real-time alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. And now for some fun. The three musketeers of options are in the money, ITM, at the money, ATM, and out of the money, OTM, each with its own character and role in your trading strategy. In-the-money options are your valiant ethos, reliable and strong, offering intrinsic value from the get-go because the stock price has already moved beyond the strike price in your favor. They're the safer bet, sporting a higher price for their inherent value, akin to playing for a guaranteed view in a high-rise hotel. You're paying upfront for the scenery you know you'll get. Yet their safety comes with a cost, a higher premium reflecting their likelihood to end profitably. On the other flank, we have the daring Aramis, the OTM options, with no intrinsic value at the outset, but holding a promise of considerable profit should the market swing your way. These are the high-risk, high-reward plays, akin to betting on a dark horse in a race. Their premiums are lower, making them accessible, but they require a sharp market upturn to breach their strike price and come into profit. And then there's Porthos, the at-the-money option standing bravely at the threshold where the stock price and the strike price meet. They represent a balance of risk and potential, their value tied closely to how the market breathes in the short term. For traders, they offer a middle ground, a blend of potential profitability and risk management. Navigating the intricate dynamics of in-the-money, at-the-money, and out-of-the-money options is like choosing the right musketeer for the battle ahead. It's about matching your strategy with the market's mood, using each option's characteristics to your advantage. Whether you're seeking the relative safety of in-the-money options, the balanced approach of at-the-money, or the speculative allure of out-of-the-money, the key lies in understanding not just the market and your financial goals, but the unique attributes and tactical applications of each musketeer in the options trading arena. All right, folks, we've traveled the options expiration date highway together, from what and why through the how to the strategic win. Armed with this knowledge, you're ready to tackle the world of options with confidence and a bit of swagger. Remember, every trader's journey is unique, but understanding the basics is your universal passport to success. Before you click away, remember this: options trading is a marathon, not a sprint. Patience, education, and a bit of courage will be your best allies. And hey, I'll be right here cheering you on every step of the way. Until next time, keep it real, and I'll see you in the next video.